Good afternoon, everyone, and welcome to Stock Market Today. My name is Ken Shreve, joined today by Ed Carson on a day that saw a lot of fireworks. Just kidding, half day of trading. But Ed somehow was able to come up with three stocks for us to watch. But it's Friday, which means we'll have a little bit of an expanded view on the market here. But before we get started, let's throw it over to Ed for three stocks to watch.
Yeah, thanks, Ken. I want to take a look at three stocks that are holding their 21-day moving average: Dexcom, Avis Budget, and Pure Storage.
Okay, well, not a lot of movement in the market today. We had the NASDAQ lagging a little bit. That was because I think Apple was under some pressure, some problems at their Foxconn manufacturing facility in China. So that was sort of a drag on the NASDAQ today, but index ended with a loss of half a tenth of a 0.5%, I should say, holding above the 11,000 level here. What are we thinking about the NASDAQ?
I mean, this is clearly the laggard. I mean, Apple is actually one of the better looking mega caps. They're all below their 200-day line, so it's not surprising that, that the NASDAQ is as well. On a weekly basis, it did advance. It sort of bounced back a little bit. It was a modest gain. But I mean, this is not. I mean, this is the laggard in the market rally, and it's just a reminder that while there are some growth stocks that are doing okay, that this is not where the rally is being led.
Definitely a laggard index. The S&P 500 looking a little better. Let's pull up the S&P today, which selling wasn't nearly as pronounced. It ended basically flat, maybe down less than 0.1%. But a key test looming here. We're holding above the 4,000 level. That's a good sign, but right at that 200-day line.
Yeah, so we got above the 4,000 level this week, bounced back this week, and got above these highs. So it's that's all nice. But yeah, this is really a test. Then we've got this. This is where we came within a point of the 200-day line on August 16th, and really all year haven't really been able to consistently hold above the 200-day line, which is a fairly minimum level to be above, and this has not been doing that. So that's a big test. And when you combine that with a lot of economic data, including inflation data, the jobs data next week, it seems like it's a big test coming up for the market rally, and it could go either way. And so that's something I think investors need to be thinking, mindful of as we head into next week.
Yeah, no doubt. I mean, next week is going to be very pivotal for the market. That core personal consumption expenditures reading that the Fed likes to look at. That's in the personal income and spending report, and also a lot of technology stocks reporting earnings next week as well. All right, well, let's check in on the Dow, which is clearly the top performing index at this point. The Dow outperformed, maybe not surprisingly, up another 0.5% or so. Really didn't have any problems here moving above the 34,000 level. This is sort of indicative of the market, Ed, as money kind of moves away from growth stocks into your industrial kind of value stocks.
Industrial names, financials, there's a lot of those names are doing really well. This has actually got above its August peak today, so and closed above it too. So this is the highest levels in 7 months for the Dow. So if this were the NASDAQ and S&P 500, we'd be saying this is a rip-roaring rally at this point. But this is 30 stocks, but it does show you that there is some strength beyond these 30 stocks, like in some of those names, like industrials and financials. So that's a positive sign, getting above there.
And the Russell 2000 also eked out a small gain, not quite as much as the Dow, but up about 0.2%. It's been trying to get above its 200-day moving average. Not having a whole lot of luck so far, but what's your take on the small caps here?
Yeah, I mean, this is sort of in between. Obviously, you'd like to see if you get the benchmark S&P 500 and the small caps to start moving decisively above the 200-day line. That would be a pretty positive sign for breadth. This made some progress. It's just not quite there. I think a decisive move above those levels would be really positive for those sectors.
Let's take a look at the 10-year Treasury yield today. It's funny. I just don't. I feel like this has almost moved to the background. It used to be we were just watching the 10-year yield as it was soaring, and people were worried about aggressive rate hikes by the Fed. But now the 10-year yield looks like it's just taking a breather here. stuck below its 50-day moving average. Arguably, this bodes well for a year-end rally, don't you think, Ed?
I do. I mean, this is coming down, and partly because, yeah, Fed rate hike expectations are coming down. Maybe also a little bit of concern about the economy. Some of the shorter end yields haven't come down quite as much, but that's also coming down. So it's, again, this is why it's so important that we get Fed friendly numbers next week. If we start seeing, a really strong job number, a really hot inflation number, you're going to see this treasury yield, all the treasury yields surge again, and the stock market is quickly going to struggle. We've had that several times this year, where we go in looking pretty good heading into a Fed meeting, Fed speech, or big Fed data, Fed related, and then things go badly. I mean, obviously we had the CPI a couple weeks ago that really sort of triggered things, and but if we don't get positive numbers, then we could revert to some real trouble.
Yeah, this is why it's sort of hard to get fully invested here from, maybe 20% invested up to 70, 80, 90% invested. You just still have a lot of wild cards out there, including next week. You mentioned the jobs report and a key inflation data point as well. So I know you've got several ETFs you want to look at that have been acting pretty well. Obviously, energy continues to do well here, and the XLE is really just kind of finding a new home above the 90 level here, and holding near highs, looking pretty strong.
It's holding pretty well, given that crude oil prices had a bad week. I mean, gasoline was a little different. Natural gas, I think, was up, but USO, which sort of tracks crude oil prices, definitely had a tough stretch and has been having a tough stretch. So it is actually impressive how the energy sector is held up. So definitely a lot of names, in oil and natural gas, LNG, and, more broadly into things like solar, coal. Still a lot of strength here.
Yeah, still seeing outperformance in the energy sector. Also want to take a look at XME, like X-ray Mary Edward, and this is the materials, or I should say the metals and mining ETF that's also in an interesting technical setup.
Yeah, I sort of have a bottoming base here and sort of a bottoming base like cup with handle here. The miners sort of look like this, and a lot of the metal stocks, at least something like there's a good number of metal and steel makers that have actually broken out or are hitting new highs. So again, sort of in that whole commodity space with energy, metals, and then also agriculture, there's some strength in those areas.
Yeah, XME is sitting right below that recent high of 52.95. So we would call that a pivot. And if it were to, really move above that, it's getting some early resistance at 52.95. But this would be viable if you get a good heavy volume move with conviction over that 52.95 area. XLI is another ETF that we want to look at. And that basically just your industrial Dow Jones ETF.
And again, showing a lot of strength here. So again, cyclical names and industrial old economy kind of names are doing quite well. It got above this level, the August level, just like the Dow itself did. So again, a lot of strength. And so when you're looking at your watch list, make sure you have industrials. Make sure you have some of these cyclical names in those areas.
And even though it's been a very, very difficult environment for a lot of your security software stocks, a lot of your cloud computing stocks in the technology sector, you do have a lot of good action in the semiconductor group, whether it's chip equipment firms or chip makers or chip designers. The SMH has rallied nicely off lows here, and it's possible that chip stocks could continue to lead this market, but the SMH has got a sort of an issue just like the S&P 500 here.
Yeah, I mean it's a key area here, getting above that area. If this can get above the S&P of the 200-day line, the S&P probably will too. There are a few chip stocks that are showing strength. I mean, maybe some specialty names, a lot of them with the EV plays. But this would be important because it's hard to have a market rally without the chips participating. They don't necessarily have to be the big mega leaders, but you want to have them at least taking part, and they're trying to. But yeah, like a lot of other things, a lot of tests, a lot of things are coming together. It's like a movie plot line where all the storylines come together, and it's just like, how is this going to come out? And we don't know the ending of it.
And then we mentioned the weakness that's been going on for several months now in a lot of these cloud computing stocks, and one way to track this area of the market is with the IGV ETF, and it's come off lows a little bit, still above the 50-day moving average here. It's interesting because we do have quite a few software stocks reporting earnings next week. We'll see if it could give IGV a lift here.
Yeah, and as you wrote about a lot of them in your earnings preview, but it's like there's Salesforce, which is a big component in IGV, along with Microsoft, a bunch of other names, some which are in the index or maybe not, but like more, but Snowflake, Zscaler, Workday, and there's a box. Most of them are pretty beaten down, and they will be nice to see. Can software come back, or will they come back and say, yeah, everybody, all the IT execs are cutting spending for 2023? And that could be negative for technology in general. So I think those reports and some of the data storage reports will be important for even beyond those companies.
Yeah, definitely. Next week, not only important because of economic data that we're going to see, but also, we got a lot of software companies set to report earnings. All right. Well, why don't we talk about some individual stocks here that are looking pretty good in the current market. The first is going to be Dexcom. DXCM is the symbol here, and this is continuous glucose monitoring systems for people with diabetes, and making a good stand at a short-term support level here.
Yeah, so after breaking out of a bottoming base and then sort of clearing a shelf on earnings, it's just sort of consolidated pretty nicely. It's sort of testing this 21-day line, which sort of coincides with the bottom of the gap up. So nice to hold support around there. I think you could view this as a handle to this long consolidation here. So you could use this as a buy point, but I sort of think that a decisive move above, the recent highs from the 21-day line can provide an early entry or a place to add a few more shares. But definitely nice action in the last few weeks and the last few months, honestly.
Yeah, really moved nicely on earnings, and it's been a fairly modest pullback here to the 21-day moving average. Next up is going to be Avis, ticker CAR, which also moved nicely above the 200 level, and it's just been kind of moving sideways. This is pretty good action to see in a daily chart as well.
Yeah, a lot of travel names are coming up, and every once in a while I see them, and it seems like every time I notice the travel stocks, that's when they go down. But they're perking up, so it's not alone. Even though a lot of the groups aren't necessarily the highest, holding 21-day line, just like Dexcom, you could see this as a handle to this longer consolidation. I think it's just above the midpoint of the base, and on a weekly, it shows some tight action, that's now going to have a 3 weeks tight after, in a little bit, it'll start showing up at the blue shaded area, really tight action in the last few weeks. So that's another positive in there so there's definitely buy points in here if it can clear that area.
So when you're seeing strength in names like Avis Budget, and you mentioned a lot of the hotel stocks and the travel stocks, and then you've got a slew of retail stocks that are outperforming. You've got financials outperforming. What can we discern? I mean, it seems to me that the market is maybe looking ahead to the second half of next year, and thinking hard landing for the economy. Maybe not. Maybe the economy is strong enough where, the Fed is going to be able to ease on their rate hikes, and it may not be such a bad year after all next year. Is that?
Yeah.
Can we make that just by looking at the action in a lot of these sectors right now?
I think that's a very good point. That's what the market thinks. Now we'll see if that's right, but it's like the market is certainly, when you think about metals are coming up and all these things that are coming up, it's not crying out hard landing. It's crying out maybe a soft landing, and we'll see. I mean, the economic data could go either way on that. And I will note that it's supposed to have profits coming down. Now that could be that rental rates come down a lot. I mean, I'm not sure how that all goes because car prices are starting to come down. So who knows how that'll all play out. It may be that rental rates come down, had really big earnings. It's still going to be really elevated from what they had before COVID. I mean, these are really some strong numbers, low PE. So even if their profits come down a little bit, there's that. But I think a lot of other areas in travel space, they're expecting to see decent profit growth in 2023.
Okay. Well, let's go outside of the rental car industry and into technology and take a look at Pure Storage. We mentioned a slew of tech earnings next week, and this one is on the earnings docket as well. I mean, I think you can rest assured that the market is going to hold this one to a very high standard, and if revenue growth decelerates or if earnings are just a small beat, that could be a problem. But Pure Storage is still, holding up well here amid pretty good growth.
Yeah, this trend line is back from when it sort of broke a trend line here, in this thing. It did try to break out from a couple of handle base. That fizzled almost right away. Didn't absolutely fail, and it's held its 21-day line. I don't think it's closed below its 21-day line since maybe somewhere in here, so it's been quite a while. That buy point technically is still valid. You might use this as sort of a new handle if you want. That also coincides with a long tight pattern. This is now going to be a 5 weeks tight, I believe, which is somewhat unusual that coincides. So, despite some up and downs, it's closed very tightly. I like a few things. It'll be the earnings thing. The outlook will be very important. Larger rival NetApp will be reporting a day earlier. It has relatively. It's not super highly valued, 27, given that it has had pretty decent growth. So the outlook, I think, will be really key. Can they, say that they're going to have pretty solid growth heading into next year? I think that'll be really big, for this company. And again, along with the software names, what are we seeing? Are we seeing companies spend? Are they willing to do that? Are they finally saying, we're cutting jobs, we've got our budgets, we are cutting back and not spending on technology next year?
Yeah, well, I mean, Micron in this group. I mean, it's not exactly the same business as Pure Storage, but Micron has been, talking about pulling back on their capex spending. So it'll be interesting to see what Pure Storage has to say. Yeah, going back to the weekly chart for Pure Storage for a second. One thing I've been looking at a little more lately, and it's kind of interesting with Pure Storage, is that we always list the stock's PE ratio, but then right below that we list the 5-year high and the 5-year low, and it's really uncanny the number of stocks that you are seeing in the technology sector trading down toward PE ratios that they haven't seen in 5 years. And Pure Storage is in this group, a 5-year PE low of 22, currently selling at 27 times earnings. So who knows? Maybe a lot of these beaten down techs have made it through the worst of it. I think next week will be telling when we hear what Salesforce and Snowflake have to say about demand. All right, Ed. Well, let's wrap it up. And we know the market is in a confirmed uptrend. We know the market tide is flowing positive. It's okay to put money to work, but one thing you want to talk about is just kind of keeping exposure modest. And what exactly do you mean by that?
Well, I don't necessarily have a set figure. I mean, for some people, it could be 20, it could be 40, it could be 50, or such. But I think it's also whatever it is, you may not want to add to that exposure much for the next few days as we wait to see what the economic data comes in. Like Thursday and Friday, we're going to sort of really get an idea from that. And the S&P, will it go through that 200-day line? Because that's a resistance area. You could see stocks moving, and then the S&P hits that level and then reverses back, and all those new buys struggle. So, whatever your exposure level, I mean, maybe you don't do a whole lot for a few days, but I really think it's a time to be preparing, because there's travel, there's data storage, there's a lot of financials, there's energy. I mean, there's medical products. There's a lot of sectors that are showing interesting action in, overall or specific stocks. So you really want to be ready, but I think maybe you just want to wait just a little bit longer. It's sort of like you don't go out for your picnic when it's still raining a little bit. Just wait, or just wait for that sun to clear out just a little bit more before really making a stand.
That makes a lot of sense, and even with the leaderboard model portfolio that I run along with David Chung, we're probably a little bit over 60% invested. We've been kind of increasing exposure in a variety of different industries, not so much tech, but just in areas of the market that are working as money kind of veers away from tech stocks. So, all right, well. Ed, as always, thanks very much for your insight. Have a great weekend, and hope everyone had a great Thanksgiving. We will be back here on Monday for another edition of Stock Market Today. Thanks very much for joining us, and we'll see you back here on Monday.